We'll keep it on the markets right now and bring in our guest, Ahmed Riesgo, Insigneo Chief Investment Officer. Thanks so much for being here, Ahmed. And just really want to start off with your take on that really disappointing results that we got out of Meta, and first quarter guidance also lower, and the way the stock is just being punished by investors today. We're seeing historic losses, as we pointed out. What is it telling us about the bigger picture tied to growth and valuations? What are you looking most closely at earnings as they come out?
Look, this is partly a consideration or a continuation of the broader theme we've seen here to start the year, where growth and tech are being hammered out there because of because of the environment we're in of higher rates. But I think the Facebook story, as long as with also other social media companies, is largely a story of, I think these people are going to be in a structural downtrend for many years. I think they're going to be coming under intense regulatory pressure. And these are just not names we want to own. What we've been telling our investors actually since October of last year is to use increases in prices in these stocks as exit points, not use dips like today as entry points. So we are sticking to that call.
And then I want to turn your attention. What are your expectations about tomorrow's government jobs report? Because we've been getting some mixed data, right? The ADP number was terrible. And then we got better than expected unemployment claims today. So it's a tale of two cities at the moment. How do you square those two things? And then does the number tomorrow actually matter? Because the Fed is so focused on lowering inflation, is a real number that we need to look at next week when CPI comes in.
I mean, I couldn't have said it better myself. Don't have a lot or high conviction on the employment number tomorrow because, like you said, we've had conflicting data points out there. But like you said, I think the most important thing that the Fed is looking at right now, and we are as well as investors, are those inflation prints. We need to start seeing those coming down. Our sort of thesis right now is that the market is sort of peak hawkishness. We need to see confirmation from those numbers, right? We need to see the second derivative of these numbers start to shift down.
And then markets now pricing in 5 rate hikes to come this year. Some are even pricing in a couple more. Where do you stand on that? And do you think that the number is too aggressive?
We think it's sort of at its peak aggressiveness right now. Ultimately, we don't think it makes much of a difference whether the Fed raises rates 4 times or 5 times or 6 times. We're talking about 25 to 50 basis points. That's not what's going to kill the economy. What we need to see is what the terminal Fed funds rate is going to be. And as long as the central bank's policy rate is below the long-term neutral rate, that won't be enough to undercut the expansion.
And then let's talk about where investors should be looking at to preserve their portfolio or look for, minimal growth at this point. I don't think anyone is expecting the double-digit growths that we saw last year. And what is your feeling on tech? Is it just a sector that's too volatile right now and you stay completely away from it? Or is there cherry picking that's happening? And if so, which areas are you interested in?
Well, I think you need to stay away from the mega cap tech names. But there certainly are opportunities within the space. But investors overall should be underweighting that space in their portfolios.
So then where should they be looking? Values, cyclicals? What are the areas that you're finding attractive at this point?
Yeah, we still like energy a lot. I know it had a very good performance last year, but we continue to like that, even with some of the risks, the geopolitical risk out there with Russia and Ukraine and other places. So we continue to like that sector. We like the financials. We like sectors that are going to be performing well in a rising rate, a sort of now paradigm shifting rising rate environment.
And then what about commodities? Is that something that you're interested in as well? In a rising rate environment, particularly?
Absolutely. Commodities are a great inflation hedge, and we have them in our portfolios precisely as inflationary hedges.
Okay, we will leave it there. Thank you so much. Ahmed Riesgo, Insigneo Chief Investment Officer.